Imagine committing $35 billion to build a massive state-of-the-art physical factory, only to wake up and find out a single software update might have just rendered that entire facility completely obsolete.
Yeah, that is the exact nightmare currently hanging over the AI memory market.
Right. And, usually when we look at this AI hardware boom, the market consensus just stares directly at the blinding light of the GPUs, the logic chips.
Exactly. They treat it like this single variable equation, like buy the companies making the processors, and you automatically win the AI revolution.
Which is such a dangerous way to invest.
It's a very clean, very simple narrative, which, I mean, almost always means it is entirely incomplete. Because when you step away from that blinding light and analyze the actual architecture of these server racks, the physical bottleneck choking these massive data centers, it isn't logic.
It's memory.
It is memory. And the diagnostic landscape of memory stocks right now is, frankly, this high-stakes capital allocation puzzle.
Yeah.
And it is full of massive mispricing.
Well, welcome to the Step Dive. Today, we are putting on our hedge fund analyst hats. We've got a stack of recent earnings reports, some deep institutional investment analyses, a highly technical presentation from SUSS Advanced Packaging, and some breaking market reports on a severe software threat to hardware.
Yeah, it's a lot to get through.
It is. Our mission today is a ruthless, totally data-driven comparison of two memory giants trying to dominate this cycle. We're looking at Micron and the newly independent SanDisk.
Okay, let's unpack this.
Yeah.
We are pitting a DRAM giant in Micron making this insane $35 billion capital expenditure bet against a highly agile, pure-play NAND flash company in SanDisk that is currently just riding a historic supply squeeze.
And the contrast in their strategic models is what makes this so critical for you, the investor, to understand right now. I mean, we are looking at two totally different ways to play the exact same structural constraint.
Right.
One is exploiting the immediate pricing power of today, and the other is, well, they're basically moistaging their balance sheet to build the infrastructure of tomorrow. So let's look at the company exploiting today. Because SanDisk's spin-off from Western Digital back in February 2025, it's starting to look like the defining corporate maneuver of the decade.
Oh, absolutely.
They cut the legacy hard disk drive business loose. They became this highly optimized, high-margin enterprise powerhouse right in time for the AI data lake explosion. I mean, the stock is up 150% in the first 3 months of 2026 alone, trading between $550 and $650.
The timing was impeccable.
It really was. But why is the pure-play NAND model suddenly printing so much money?
The catalyst here is what institutional analysts are calling the silent squeeze in the NAND market. The data shows contract prices for NAND surged 38% in the first quarter of 2026 alone.
38% in 1 quarter.
Yeah. And because SanDisk ruthlessly optimized their manufacturing footprint during that brutal 2024 downturn, they didn't have these heavy bloated costs to cover.
Right, their operating leverage was coiled tight.
Exactly. That means almost every cent of that 38% price hike fell straight to their bottom line.
Which totally explains the sheer magnitude of their Q2 2026 earnings. They didn't just beat Wall Street's estimates, they obliterated them.
Yeah, it was a blowout.
Analysts were looking for, $4.85 in earnings per share, and SanDisk delivered $6.20. Revenue hit $3.03 billion, which is up 61% year over year. But, okay, I have to ask about the mechanics driving this.
Yeah.
Because the memory sector is notoriously cyclical. It constantly falls victim to the bullwhip effect, where a tiny spike in consumer demand causes massive overordering at the factory level, which leads to a massive glut.
Right, the classic boom and bust.
Exactly. So here's the real question nobody's asking. Is this a structural shift in AI storage, or just another cyclical sugar high that will crash the moment manufacturing capacity catches up?
What's fascinating here is the underlying cause of this specific shortage. That's what makes it structural rather than cyclical.
Okay, how so?
It is not just an unexpected spike in demand from hyperscalers. It is a fundamental deficit on the supply side. During the recent downturn, semiconductor fabrication equipment across the entire industry was aggressively diverted.
Diverted to where?
Factories retooled their lines to manufacture high bandwidth memory, or HBM, specifically to feed NVIDIA's logic chips.
Oh, wow. So the equipment needed to make traditional storage chips was literally cannibalized to make high-speed AI memory chips.
That is the core of the issue. You cannot just flip a switch and build a new fab or retool a line overnight. Because those traditional NAND lines were starved of tooling for 2 years, the global capacity to flood the market simply does not exist right now.
It's a physical bottleneck.
Exactly. This structural deficit means SanDisk's current BiCS8, that's their 218-layer chip, and their upcoming BiCS10, which is this massive 332-layer chip, they have immense locked-in pricing power through at least 2027.
And it's also a product edge, right? Not just a pricing story. Because in early 2026, SanDisk launched the world's first 256 terabyte enterprise SSD. And this is a crucial detail for you to understand. This drive wasn't built for consumer laptops. It was designed specifically to consolidate AI data lakes.
Right. You're not putting 256 terabytes in a MacBook.
No, exactly. And if you're wondering why a hyperscaler cares about one massive 256 terabyte drive versus, say, 50 smaller ones, it comes down to the secondary bottleneck of AI, power and cooling.
The energy load.
Right. Condensing dozens of server racks into a single unit drastically reduces the energy load required to keep the facility from overheating.
And we should also briefly contrast this pure play success with Western Digital, the company SanDisk spun out from.
Oh, yeah, the WDC side of the split.
Right, because Western Digital kept that legacy hard disk drive, the HDD business. And the market consensus assumed HDDs would just die in an AI world. But Western Digital is actually capturing the warm data AI inference tier.
Meaning, when an AI isn't actively training on new data, but it's just referencing vast amounts of existing information, HDDs are still vastly cheaper per terabyte.
Precisely. And Western Digital is proving that by pushing out these 32 terabyte ultra SMR drives, hitting record gross margins of 46.1%.
46% on hard drives, that's wild.
It proves that extreme specialization is the winning formula right now. Western Digital dominates the cheap, warm data inference tier. SanDisk dominates the high-speed NAND flash AI data lake tier.
Okay, so SanDisk proves that staying nimble in NAND is a total gold mine right now. But what if you can't be nimble?
Right.
What if your product requires the most complex, heavy industry manufacturing on planet Earth? That brings us to Micron's blowout and, frankly, highly controversial quarter.
Yeah, controversial is the right word.
Q2 2026 revenue nearly tripled year over year to $23.86 billion. Earnings per share at $12.20. Gross margins hit a staggering 74.4%.
Which is phenomenal.
It's historical. They're basically selling out of high bandwidth memory through the end of the year, yet the stock tanked 30% from its peak.
Which tells you everything you need to know about how institutional money evaluates semiconductor stocks. The market is terrified of their aggressive capacity expansion.
The CapEx bill.
Yeah. Micron's management announced over $25 billion in capital expenditure for fiscal year 2026, plus an additional $10 billion step-up for 2027, all to build mega fabs in Idaho and New York.
The market looked at a $35 billion bill and just immediately hit the sell button.
They did.
If you're listening to this, the obvious question is, why does it cost $35 billion just to stay competitive? What are they actually building that costs the equivalent of a small country's GDP?
To understand the sheer scale of that number, we have to look at the manufacturing reality outlined in the recent SDSS investor presentation.
The advanced packaging data.
Right. It details the unforgiving complexity of advanced packaging. As the industry shifts from the current HBM3E standard to HBM4 and eventually HBM5 around 2027 or 2028, the physical architecture of the chips is fundamentally changing.
They're going vertical.
Exactly. Manufacturers are stacking 12, 16, even 20 layers of DRAM on top of each other.
It is essentially building a microscopic skyscraper of memory.
That's a great way to visualize it. But the challenge is how you connect the floors of that skyscraper. Currently, the industry uses thermal compression bonding, or TCB.
Okay.
Think of it as using microscopic solder bumps to fuse the layers together. But to stack them 20 layers high, there isn't physical room for solder anymore. To reach the density of HBM4, Micron has to transition to hybrid bonding.
Help me understand the mechanics of that. If you aren't using solder, how on earth do you connect the layers?
Hybrid bonding forces copper directly against copper at a microscopic level, creating a connection without any solder at all.
Wow.
But doing that requires an environment with an entirely new level of vacuum cleanliness and precision alignment. If a single speck of dust gets between those layers, the entire chip is ruined.
Just one speck.
Just one. So Micron must spend billions of dollars on this highly specialized equipment just to keep up with the technical difficulty of the roadmap.
Okay, so the market sees that $35 billion in CapEx as this massive future depreciation weight. The bear thesis is simple, right? You're building these massive fabs, but when the cycle eventually turns and demand cools, all that expensive equipment just sits idle. depreciation eats the balance sheet, and that beautiful 74.4% gross margin gets absolutely crushed.
That's the fear.
But I have to push back on that consensus. Micron has no choice. I mean, in this capacity race, failing to expand is literally handing future NVIDIA orders directly to Samsung and SK Hynix.
Oh, it is an existential game of poker. Because Micron's current HBM capacity is only 1/3 the size of Samsung's. And SK Hynix currently holds a rumored 70% grip on NVIDIA's HBM orders.
70%.
Yeah. If Micron wants to break that monopoly and secure their place in NVIDIA's next-generation Vera Rubin supply chain, they have to build the physical capacity to supply it.
They are buying a seat at the table. If they don't spend the $35 billion, they are relegated to the low-margin commodity tiers, while SK Hynix just scoops up all the high-margin AI revenue.
Exactly.
So they are forced to spend tens of billions to build physical capacity. But let's go back to that nightmare scenario I brought up at the start. What if a software breakthrough suddenly makes all that physical capacity totally redundant?
Ah, yes. This is the exact fear that triggered the late March sector sell-off, the software threat.
Right.
On March 24th, Google Research published a paper on a new algorithm called TurboQuant.
Here's where it gets really interesting, because this algorithm fundamentally attacks the hardware thesis. TurboQuant reportedly compresses the key value cache, the KV cache, of large language models by at least 6x with absolutely no loss in model accuracy.
Which sounds terrifying for hardware.
It does.
Right.
For those unfamiliar, what is the KV cache doing mechanically, and why does shrinking it terrify hardware investors?
Think of the KV cache as the short-term memory scratchpad for an AI.
Okay.
When a large language model is generating a paragraph, it uses the KV cache to remember the mathematical calculations of the previous words, so it doesn't have to constantly redo the math from scratch every single time.
Which takes up a ton of space.
It is highly memory intensive. So if Google can shrink that scratchpad footprint by 6 times using a software algorithm, the market immediately does the math. If you need 6 times less memory to run an AI, do you still need Micron's new megafabs?
And the sector panicked. Micron fell 20% over 6 sessions. Western Digital dropped 15%. If software can do the work that hardware was expected to absorb, does the entire $35 billion capex thesis for Micron just collapse?
If we connect this to the bigger picture, we really have to separate laboratory panic from deployment reality.
Okay, unpack that.
First, TurboQuant is currently just a laboratory result heading to the ICLR academic conference. It is not deployed at a global production scale. But more importantly, look at the capital allocation behavior of the company that published the paper.
Google.
Yes, Google is simultaneously ramping its own 2026 capital expenditure to roughly $180 billion.
Wait, let's highlight that contradiction. Google is publishing a paper saying they can use 6x less hardware while simultaneously spending $180 billion buying more hardware.
It points directly to a well-known economic principle, the Jevons paradox.
Right.
Historically, whenever you dramatically increase the efficiency of a resource, it does not lead to a decrease in consumption. It actually leads to a massive increase.
Oh, like with LED bulbs.
Exactly. When LED light bulbs made lighting 10 times more energy efficient, we didn't use 10 times less electricity globally. We just lit up everything, everywhere, all the time.
Because it lowers the cost of entry, which brings in a flood of new demand, software efficiency in AI will ultimately require more physical hardware because the ambition of the software scales up instantly to consume whatever headroom was just created.
Precisely.
If an LLM suddenly takes 6x less memory, developers won't buy less memory. They will just build models that are 6x larger and run more complex, agentic AI.
So the TurboQuant panic represents a fundamental misunderstanding of how hyperscalers consume resources.
Okay, so if the panic is overblown, it means the market is drastically mispricing the long-term cash flows of these memory companies.
Without a doubt.
Let's look at that valuation reality check and the forward catalysts, because both Micron and SanDisk currently present extreme valuation anomalies that require rigorous scrutiny from anyone looking at the space.
Let's start with Micron.
Right now, Micron trades at an incredibly compressed 3.95 times next 12 months price to earnings. A sub-4 PE ratio for a company posting 74% gross margins in the middle of an AI boom is almost unheard of.
It is. That multiple reflects deep, deep institutional skepticism. Advanced modeling from platforms like Ticker warns that if those multiples compress any further, which is frankly a historical reflex whenever memory cycles show signs of peaking investors, could actually see a negative 15.3% total return by 2030, despite the AI tailwinds.
That's a brutal forecast.
The market is aggressively pricing in a crash in utilization rates.
The downside risk is definitely real. But if Micron's new 1-gamma DRAM and G9 NAND nodes execute flawlessly and they fill those new New York and Idaho fabs with high-margin HBM4 orders from NVIDIA, the operating leverage will be absolutely massive.
Oh, yeah.
You are looking at a potential slingshot effect in the stock price once those depreciation fears are cleared.
And then look at the catalyst for SanDisk. In the data center, they are actively exploring high bandwidth flash, or HBF.
What does that do?
This is an architecture designed to bridge the gap between cheap NAND and hyper-expensive HBM. So they're moving up the value chain. But they also have a massive demand catalyst completely outside the data center, the edge AI cycle.
Ah, the mobile segment.
Yes.
Because as Apple and Samsung bake local large language models directly into their phone operating systems, the base storage requirement for a standard smartphone is being forced upward. We are seeing the baseline move from 256 gigabytes straight to 1 terabyte.
And that is a 4x increase in baseline mobile storage volume.
Yeah.
For SanDisk, which dominates the client and mobile NAND space, that creates a multi-year tailwind that has absolutely nothing to do with hyperscaler CapEx.
It's a totally separate pillar.
Exactly. It provides an entirely separate revenue stream that protects them, even if the data center market cools off. This raises an important question about capital allocation.
Which is?
SanDisk offers you a pure-play, high-margin narrative. They have pricing power today, and they aren't burdened by building $20 billion DRAM fabs.
Right. If you are evaluating these stocks for your portfolio, you aren't just betting on the concept of AI. You are betting on whether supply can stay disciplined against an infinite demand curve.
While Micron offers you a foundational strategic asset, they are an indispensable pillar of the AI infrastructure. I mean, you literally cannot build an NVIDIA server without high-bandwidth memory, but they carry massive execution and depreciation risks. You are paying heavily for their capital intensity.
Okay, if you remember one thing from this analysis, it's this. The AI revolution is constrained by memory, not logic. SanDisk is exploiting the immediate NAND shortage to print cash today, while Micron is mortgaging its present cash flow to buy a seat at the future HBM table.
It really is a battle between capturing the margin of today versus building the infrastructure of tomorrow.
It is. And before we go, I want to leave you with a final puzzle to mull over. A variable that isn't on the balance sheets but could dictate everything.
The geopolitical factor.
Exactly. What happens to the global tech balance of power if AI memory becomes highly localized? Look at Micron. They're building these mega fabs in New York and Idaho, heavily subsidized by the U.S. CHIPS Act. They are securing American supply chain sovereignty.
Right.
Meanwhile, SanDisk relies heavily on Asian assembly and its joint venture in Japan. In the end, will the ultimate winner of the memory supercycle be decided by hybrid bonding technology and software compression, or by geopolitics and supply chain sovereignty?
It's a great question. Because the underlying hardware is only as valuable as the supply chain that protects it.
So true. Thank you for joining us on this deep dive. Keep questioning the consensus, watch the data, and we'll see you next time.